Hello, this is Leroy Meadows, and in this session, we're going to work some exercises on variable costing analysis. So let's go ahead and get started with our first exercise. Cool Sky reports the following for its first year of operations. The company produced 44,000 units and sold 36,000 units at a price of $140 per unit. So we're asked to do a couple things. Well, actually, we're asked to do four things. Assume that company uses absorption costing. So under that scenario, we have to determine the total product cost per unit and then prepare an income statement under absorption costing. And then we have to assume the company uses variable costing. And then after that, we determine the total product cost per unit using variable costing and then prepares income statement for the year under variable costing. Okay, so let's get started here. The first part, we're asked to assume the company uses absorption costing. So determine its total product cost per unit. So let's look at absorption costing. We know that absorption costing absorbs the full range of manufacturing or factory costs in computing the product cost. So under absorption costing, we're going to consider both variable and fixed overhead costs. So let's take a look here. Our direct materials cost is going to be $60. Direct labor, $22 per unit. Variable overhead, $8 per unit. And then I'm going to have fixed overhead. Now I need to determine what my fixed overhead cost per unit is in order to get a total product cost per unit. What I'm going to do is I'm going to take that $528,000 and divide that or spread it out over the number of units produced, not the number of units sold, the number of units produced. And we're told here the company produced 44,000 units. So I'm going to spread that $528,000 over 44,000 units produced. And I get a cost of fixed overhead of $12. So I'm going to put that here. And so what is my total product cost under absorption costing? My $60 plus for direct materials plus direct labor of 22 plus variable overhead of $8 per unit plus fixed overhead of $12 per unit. So that's going to give me a total product cost of $102. And I'll put that over here so we have that easy to get to. So now we're asked to prepare this income statement for the year under absorption costing. So I have to prepare an income statement, so it's based on the number of units sold. So I'm going to complete everything based on the number of units sold. So how much did I sell each unit for? $140. So I'm going to take $140 and multiply that by 36,000 units sold. And that'll give me total sales of $5,040,000. So I'm going to place that in here. Now I need to compute my cost of goods sold. And again, this is all the sales and cost of goods sold is going to be based on the cost of goods sold is going to be based on the number of units sold. So the product cost per unit is $102 times 36,000 units sold. And that's going to give me cost of goods sold of $3,672,000. And from there, we can compute our gross profit, which is our sales minus our cost of goods sold. And when I compute that out, excuse me, I should get $1,368,000. Now on a traditional income statement, my selling and administrative expenses. Now my selling and administrative expenses here comprise of what? Both variable and fixed selling and administrative expenses. So I'm going to combine the two for this one line item here. So I'm going to take my $11, I'm going to compute my variable units, my variable selling and administrative costs first. So I'm going to take my $11 variable cost per unit, and let me go back here. Let me put that in parentheses. Oops. I already have parentheses. Oh, let me clear that out here. Okay, $11 variable administrative and selling expenses per unit times 36,000 units. So my total variable selling and administrative expenses, $396,000. Now I'm going to add to that the 105,000 over here, so plus 105,000, and that gives me total selling and administrative expenses of $501,000. So 501. So what's my operating income here? I'm going to simply take my gross profit minus my selling and administrative expenses, so 1368 minus 501,000, and I have an income of $867,000. Now let's look at variable costing. What were our product costs going to be and an income statement under variable costing? So in order to do the income statement, I need to know the product cost per unit. Well, under variable costing, I'm going to include direct materials, direct labor, and variable overhead. So let me go ahead and include those. Now remember, fixed overhead is treated as a period expense under variable costing. So we're going to expense that off as an entirety. So if we're going to expense it off, it's not going to be included in the product cost under variable costing. So when I compute my product cost per unit using variable costing, it's going to be 60 plus 22 plus 8 is $90. So my total cost per unit under variable costing, $90. So let me go ahead and put that over here as well. Now let's go ahead and do our income statement under variable costing. So my sales, I sold 36,000 units at $140 per unit. My sales were $5,040,000. Now we're going to look at our variable expenses. And because we're doing a variable income statement, a variable costing income statement, as opposed to the contribution margin income statement, we're going to separate the variable cost of goods sold from the variable selling and administrative expenses. So my variable cost of goods sold is what? $90 times the 36,000 units sold gives me a total of $3,240,000. So $3,240,000. And now my variable selling and administrative expenses is what? $11 per unit times 36,000 units sold. $396,000. So in order to calculate contribution margin, I take my sales minus all my variable expenses. So I need to figure out my total variable expenses, 3,240,000 plus 396,000 gives me total variable costs of $3,636,000. And when I subtract that from our sales, I will get a contribution margin of $1,404,000. Now from there, I'm going to subtract out my fixed expenses. My fixed expenses were what? $528,000 for overhead, and selling administrative were $105,000. So my total fixed overhead or my total fixed expenses are going to be what? 528,000 plus 105,000, $633,000. So I want to take my contribution margin of $1,404,000 minus my $633,000 of fixed expenses, and I will get $771,000. Now, we know that under absorption costing, my operating income is going to be greater. We already know this for one reason, because production is greater than sales. I produced more than I sold, so my operating income is going to be higher. Now, why is it higher? Because under variable costing, my fixed overhead was expensed off entirely. Under absorption costing, the only fixed overhead that was expensed were those included in cost of goods sold, and we sold 36,000 units. So the difference between these two, if I look at it, is what? 867,000 minus 771,000. The difference is $96,000. And that's because under absorption costing, I have, let's see, 44,000 units I produced. I sold 36,000 units, so I have 8,000 units in ending inventory. And that ending inventory is absorbing some of that fixed overhead that was expensed under variable costing, but not under absorption costing. So my difference in operating income under the two methods, $96,000. If I go back and I figure my $12 of fixed overhead times the number of units still in inventory, remember we produce units and it's either sold or not sold. If it's sold, it's expensed off as cost of goods sold. The other remaining units that were not sold are in inventory. So I'm taking my $12 per unit of fixed overhead in ending inventory, or $12 per unit times the amount in ending inventory, $8,000, or 8,000 units, and that's $96,000 of fixed overhead that is not expensed off under absorption costing, because those 8,000 units are still in ending inventory. Now, if we sell those 8,000 units in the next period, then I'm going to expense those off, and then if I produce less next month than what I sell, then the results will be flipped. My variable cost income will be higher than my absorption costing income. But for now, because I produced more than I sold, my absorption income is higher than my variable income, and we see that right here, and we just saw that attributed to fixed manufacturing overhead that's in ending inventory. Okay, so let's move on to our next exercise here. And let's take a look here. HUD Incorporated reports the information below on its product. The company uses absorption costing and has a target markup of 40% of absorption cost per unit. Compute the target selling price per unit under absorption costing. Okay, so whenever we're looking at target pricing, it's always got to be based on the full product cost. And that includes direct materials, direct labor, all overhead, whether it's variable and fixed. So let's take a look at the information here and compute the target selling price. So the first step is get the absorption product cost per unit. So I have $100, and I'm just going to look here and refer to this. Direct materials are $100 per unit. Direct labor, $30 per unit. And let's see, variable overhead of $8 per unit. And then $600,000 of fixed overhead per year. So we have to go by, in order to spread that out, we have to go spread that out over units produced. So I'm going to take that $600,000 and spread that out over the number of units produced, 50,000. And I'm going to get $12. So my absorption product cost per unit is going to be what? So I'm going to add all these together now. $100 plus 30 plus 8 plus 12. And that should give me an absorption product cost per unit of $150. So put that right there. So now, and I need to figure out my selling price. So I'm going to start with is absorption product cost per unit, $150, times my or plus my target markup per unit. So how much of a markup do I want? Well, the company uses absorption cost. It has a target markup of 40% of absorption cost per unit. So I'm going to take that $150 times 40% of that, and that's $60. That's going to be my desired markup. So my desired markup is $60, and my target selling price per unit then is going to be my cost per unit plus my desired profit per unit, or my desired target markup. So I'm going to take 150 plus 60, and my targeted selling price per unit is $210. And that's what I want to. That's where I want to set my selling price. So that way, when I take my full absorption costs into account, I'm going to make $60 per unit off my sales there. So that is how we compute the target selling price per unit. Okay, now let's take a look at the next exercise here. Empire Airlines reports the following cost data for the year. The company flew 100 private flights during the year. A group has offered Empire $11,000 for a private flight to Chicago for its members. We're asked to compute the contribution margin, or what is the contribution margin from accepting the offer. So if we accept the offer, what is the contribution margin? And then B, should the offer be accepted or rejected? Okay, so the first thing I need to do is figure out my contribution margin. So my contribution margin, I'm going to take my revenue minus my variable costs. So what is the revenue that they propose, or they're going to pay me? What are they going to pay me to charter a private flight from Chicago, or flight to Chicago for its members? Well, the offer was we were going to get paid $11,000. So I'm going to take that into account. So $11,000. So that's my starting point. Now from that, I'm going to subtract out my variable costs. So variable costs, and we're listed here. So let's go through these individually here and see which costs are variable and which costs are fixed, because when we're accepting a special order or a special offer, then we do not want to consider fixed costs in this situation, because the fixed costs are going to have no bearing on. If there was an increase in fixed costs, then we would have to take into account that increase. If there was a decrease in fixed costs, then we would have to take into account that decrease. But since we're not having an increase or decrease in fixed costs, we do not need to make any of those considerations. So let's just look at what's variable. So we have wages, salaries, and benefits. Well, that's variable because it's based on a per flight. So let's look at wages, salaries, and benefits. And that's what, $7,000 per flight. Then we have fuel and oil, because that's base per flight, and that's $4,500. And then we have food and beverages, $500 per flight. So what are my total variable costs here? Well, I'm going to have $7,000 plus $4,500 plus $500 is $12,000 of variable costs. So my total variable costs are $12,000. So if I take revenues minus my total variable costs, I'm going to actually have a contribution margin of negative $1,000. So basically what that's telling me, because I have a contribution margin in the negative, that I lose $11,000 of income if I accept this offer. Why? Because they're only giving me $11,000, and it's going to cost me $12,000 just for the flight itself. And that's not even taking into account our fixed costs. So Should the offer be accepted or rejected? It should be rejected. Why? Because we have a negative contribution margin. The special offer price is less than the variable cost of the flight. So in this case, Empire would want to reject this offer. Okay, let's look at another exercise here. Pro Bike manufactures and sells two types of bikes, road bikes and mountain bikes. The company sold 600 units of each type of bike during the year. And so we're given the information here. And we're asked to compute the contribution margin in dollars for each product. And I see I'm missing a parentheses there. Let's just fix that because it's going to drive me nuts if I don't. Okay, so what is my contribution margin in dollars for road bikes? Well, my contribution margin is what? Sales minus variable cost of goods sold minus my variable selling expenses. So sales price $1,200 minus $840 for variable cost of goods sold minus $60 for variable selling and administrative expenses, and I get a contribution margin of $300. Now, that's per unit. Now, I want to if I want to see my total contribution margin in dollars for each product, then I want to take the contribution margin per unit and multiply that by the number of units sold. And we're told here they sell 600 units of each type of bike. So my contribution margin in total for road bikes is $180,000. So, and let me go ahead and format this. I thought I'd already done that. I had not. So now we're going to do the same thing for mountain bikes. We're going to look at the contribution margin per unit and then multiply that by the number of units sold to get the total contribution margin. So my $800 sales price minus my variable cost of goods sold of $480 minus my variable selling administrative expenses of $64, and I will get $256 as my contribution margin per unit. I'm going to multiply that by the number of units sold, 600, and I should get $153,600. So let me put that over here. And so that's my contribution margin for each of the road bikes and mountain bikes. Now we're also asked compute the contribution margin ratio for each product. Which product has a better contribution margin ratio? Well, if we remember, the contribution margin ratio is just a contribution margin divided by sales price. And that's going to be true on an individual level and on an aggregate level. So let's do road bikes. Let's figure out my contribution margin. So 1,200 minus 840 minus 60 gives us a contribution margin of $300. Now I'm going to take that and divide it by 1,200, my sales price, and that's 25%. So road bikes is yielding me a contribution margin of 25%. And let me format that here. There we go. Now let's do the same thing for mountain bikes. Take my sales price minus my variable expenses, and that got me a contribution margin of $256. When I take that $256 and divide that into the sales price, I get a contribution margin of 0.32 or 32%. So which product has a better contribution margin ratio? Mountain bikes does, because for each dollar of sales, a greater percentage of the sales is going to cover fixed costs than it would be for selling a road bike. So mountain bikes has the highest contribution margin ratio, or a higher percentage of sales that's going to cover fixed costs. Okay, Let's look at our next exercise and our last exercise of the session here. A manufacturer reports the following information for the past 3 years. Compute income for each of the 3 years using absorption costing. Hint, fixed overhead and inventory equals the fixed overhead per unit times units in inventory. Okay, so I'm going to use this formula here, but I'm going to start out with my premise because all we're being asked to do is compute income under variable costing and convert it to income under absorption costing. Okay, so let me take a look here. And what I'm going to do here is I'm going to merge these two. And then prepare this here. Okay, so what I want to solve for is this right here. So I'm going to start off my income under variable costing, which is what, $110,000, plus my fixed overhead and ending finished goods inventory. And I have 1,200 units, and we're told that fixed overhead per unit is $250. So 1,200 times 2.5 gives me $3,000. Minus my fixed overhead and beginning finished goods inventory. Now I had no units in beginning finished goods inventory, so I don't have to worry about this. So all I have to do now is take my 110,000 plus 3,000, and my absorption costing income is going to be $113,000. So I'll just put that right here. Okay, so now let's look at year 2. I start off with inventory or income under variable costing, which is what, 114,400. I'm just typing these in here so I can keep track of my numbers. Plus fixed overhead and ending finished goods inventory. So I have 700 units in ending inventory at $2.50 per unit. So addition to that is my $1,750, my fixed overhead and ending finished goods inventory, minus my fixed overhead from beginning finished goods inventory. And that was what? 1,200 times 2.5, I think it was 3,000. So when I follow the formula and I add this up or I net this out, 114,400 plus 1,750 minus $3,000, my absorption costing income statement or income for the year 2 will be $113,150. Okay, now let's look at year 3. Year 3, we start off with our variable costing income of $118,950 plus our amount of fixed overhead and ending finished goods inventory, which is going to be what, 250 times 800. Oops. Which would be $2,000 minus my fixed overhead and beginning finished goods inventory. So that was what? 700 units times 250 equals 1,750. Now I'm going to go ahead and add that up and then subtract this out. So 118,950 plus 2,000 minus 1,750. And that gives me absorption income of $119,200. And there we've solved and answered the question. Now, I did include this because while this would not predict the actual operating income under absorption costing, we can look at the results to see, and it should give us at least a little check to see if we've done it right, or at least that we're in the right direction. What do we have here? Well, we had here a situation in year one where we had ending finished goods inventory and we had no beginning finished goods inventory. So what happened? We produced more than we sold. So our operating income under absorption costing should be greater than operating income under variable costing. And this is greater than variable costing. Now in year two, we actually sold more than we produced. Why? Because my ending finished goods is less than what I started out with. So I sold more than I produced. So when production is less than sales, absorption should be less, income should be less than variable costing. Absorption costing income, 113,150, and that is less than the 114,400 we were given for variable costing. Now let's look at year three. Absorption costing gives us operating income of $119,200, and that is greater than the variable costing income. And we see here that we had produced more than we sold. So since production is greater than sales, absorption income should be greater than variable costing income. And we do see that played out here as well. So I included this box here just as a check to make sure that at least I was on the right track, because if production is greater than sales, but my variable income had been lower or had been higher than absorption costing, then I would have known I made an error somewhere. It's not a fail-proof way to check, but at least it's a check that we can use to see if we're at least going in the right direction here. So, my name is Leroy Meadows. That concludes this session. Have a good day.